Welcome to Group Insurance Daily Pulse, your rapid-fire dive into the most impactful developments shaping our industry. I'm Aria the Actuary, scrutinizing the numbers.
And I'm Dorian the Distribution Expert, always looking for the next market opportunity. Let's get straight into it. Today we're covering shifts in auto insurance, new federal benefits, rate reductions, GLP-1 strategy, and state leave expansions. Fasten your seatbelts.
First up, a significant regulatory tremor from Ontario, Canada, impacting group health carriers. Effective July 1, 2026, Ontario auto insurance policies are undergoing a major overhaul. The key takeaway, Aria, is that auto insurance will now become the first payer for medical and rehabilitation claims, excluding medication, reversing the previous sequence where group health benefits were primary.
Reversing the first payer sequence is not a tremor, Dorian. It's a seismic shift in coordination of benefits logic. For accidents post-July 1st, 2026, our group health blocks will see a reduction in initial claim volume and expenditure for some accident-related medical and rehabilitation claims. However, the operational friction of adjusting COB processes across our entire Canadian book is substantial. We're talking about reprogramming claims adjudication systems, updating plan documents, and re-educating claim staff on a fundamental change in payment hierarchy. But Aria, this isn't just about claim processing. It's a strategic opening. Several accident benefits, income replacement, non-earner, caregiver, death and funeral benefits, previously mandatory, are now optional under auto policies, applying only to named insureds and their families. This creates a glaring coverage gap for individuals not explicitly covered by a personal auto policy, like pedestrians or cyclists. That's a direct market opportunity for supplemental group accident or critical illness benefits.
Employers will need to ensure their workforce understands these changes, and brokers are positioned to consult on filling these newly created voids in personal accident coverage. It's about proactive employee protection and benefit enhancement. Gaps and opportunities are two sides of a very expensive coin, Dorian. The optionality introduces significant adverse selection risk. If individuals choose not to elect these benefits and then suffer an accident, the employer could face significant employee dissatisfaction or even pressure to cover costs ex gratia, impacting their internal P&L. For our fully insured blocks, while our exposure might be reduced by the auto first payer rule, the administrative burden of verifying auto coverage and benefit election status for every accident claim will be immense. We need robust data sharing protocols with auto insurers, which are often non-existent or highly inefficient.
Furthermore, the mandatory medical and rehab limits, $65,000 for non-catastrophic, $3,500 for minor, $1 million for catastrophic, are critical. Once those auto limits are exhausted, group health becomes primary again. Our reserving actuaries need to recalibrate for this potential shift in long-tail liability, particularly for catastrophic impairments, where the auto limit, while substantial, may not be exhaustive. The DOI filings for plan document amendments across all our Ontario groups will require significant lead time and legal review. Solvency implications hinge on our ability to accurately reprice and manage this new risk distribution. It forces the conversation, Aria. Employers in Ontario must reevaluate their entire benefits ecosystem. This isn't just a compliance issue, it's an employee value proposition issue.
We can be the solution providers, offering integrated accident and critical illness solutions that bridge these new gaps, enhancing employee retention and demonstrating a commitment to comprehensive well-being. The market share potential for carriers who can swiftly adapt and offer clear, concise solutions to employers navigating this complexity is significant. Adaptability requires precise actuarial modeling and system readiness, Dorian, not just marketing slogans. The lead time to July 2026 is tight for such a fundamental shift. Our P&L will be directly impacted by the efficacy of our COB reengineering and the accuracy of our revised claim cost projections. This is a high-stakes operational and financial challenge. Shifting gears to domestic policy, Dorian, the One Big Beautiful Bill Act, or OBBB, is activating key employee benefits changes for 2026. What's the distribution angle on this?
Aria, this is pure gold for employee attraction and retention, particularly for family-focused benefits. Most OBBB changes kick in for tax years beginning after December 31st, 2025.
Two big ones. The annual income exclusion for dependent care assistance programs, or DCAPs, increases from $5,000 to $7,500, or $3,750 for married filing separately. That's a 50% increase, providing substantial tax advantages for employees with childcare expenses, which should boost DCAP participation significantly. But the real game changer is the launch of employer contributions to Trump accounts.
Trump accounts. The name alone raises eyebrows, Dorian. Let's stick to the technicals.
The DOL's clarification is intended to lower the compliance barrier, Aria. It allows employers to contribute up to $2,500 annually per employee, counting towards a $5,000 aggregate annual contribution cap starting July 4, 2026.
Flexible, perhaps, but administratively complex. The DCAP increase is a straightforward positive, enhancing an existing benefit without significant new operational overhead for us. But Trump accounts are entirely new. Integration into our benefits administration platforms means new data fields, new reporting requirements, and ensuring our systems can accurately track contributions against the $2,500 employer cap and the $5,000 aggregate cap, particularly if multiple employers contribute for the same child, or if the federal seed deposit needs to be accounted for in any way. We need to understand the tax implications beyond federal. State conformity or divergence could create a patchwork of compliance requirements. The avoid endorsing the program condition is particularly vague and could expose carriers to reputational or regulatory risk if our marketing or integration strategies are perceived as crossing that line. This is a new segment, yes, but one fraught with implementation friction and potential P&L impact from unforeseen compliance costs or liabilities. Our legal and compliance teams need to issue robust guidance immediately.
This is about being first to market with comprehensive solutions. Carriers who can seamlessly integrate Trump accounts into their voluntary benefits offerings, perhaps alongside existing 529 plans or other financial wellness tools, will capture significant market share. It's a tangible way for employers to invest in their employees' children's futures, driving engagement and loyalty. The ROI on enhanced employee experience and reduced turnover from these types of family-focused benefits is substantial. We need to empower our brokers with clear messaging and administrative pathways to present this as a compelling new benefit.
Seamless integration is often a euphemism for unforeseen IT spend and new regulatory risk. Before we talk market share, we need absolute clarity on the ERISA conditions, the tax treatment across jurisdictions, and our own internal protocols to mitigate any perception of endorsement. The P&L impacts from system development and compliance oversight for this new product line must be carefully modeled. This isn't a simple benefit add-on. It's a new financial product with significant regulatory considerations. Moving to some potentially more straightforward news, Dorian, the Virginia Retirement System, or VRS, is reducing optional group life insurance rates. Tell us what you're seeing.
Absolutely, Aria. This is excellent news for VRS members and a positive signal for the group life market. Effective July 1, 2026, the VRS Optional Group Life Insurance Program will implement an overall rate reduction of 3%. Specifically, monthly premium rates paid by members will decrease across 6 key age brackets: 50-54, 55-59, 60-64, 65-69, 70-74, and 75+. For instance, ages 50-54 will see a reduction from 20 cents to 19 cents per $1,000 of coverage, and 70-74 from $2.06 to $2 per $1,000. Securian Financial is the contact, indicating they underwrite the program. This demonstrates strong plan experience and a commitment to passing savings on to members.
While rate reduction is generally a positive headline, my actuarial brain immediately asks, why? A 3% overall reduction suggests favorable mortality experience within that specific VRS block, or perhaps improved investment returns on reserves, or even successful reinsurance negotiations. For Securian, it indicates a well-managed program with strong underwriting discipline. For the broader group life market, this is a competitive benchmark. Are our own group life blocks experiencing similar favorable mortality trends? If not, why not? Are our pricing assumptions still robust, or are we potentially leaving money on the table? Or conversely, are we at risk of adverse selection if our rates are less competitive for comparable groups? This could trigger a review across the industry, potentially leading to downward pressure on rates, which would directly impact our P&L and reserving adequacy if not managed proactively.
This is precisely what I mean, Aria.
It's a key selling point for brokers. When a large, well-established program like VRS can reduce rates, it highlights the value of robust, well-managed group life insurance. It encourages other self-funded employers and even fully insured groups to review their own plan performance. It's an opportunity for us to engage with our clients, demonstrating how strong plan design and proactive management can lead to tangible benefits for their employees. It's about enhancing member value and driving participation in essential protection benefits. Member value is important, but solvency is paramount. We need to conduct an immediate internal review of our group life blocks, particularly those with similar demographic profiles to the VRS, to assess if our current pricing adequately reflects present mortality trends. A 3% overall reduction doesn't mean a uniform decrease. The specific age bracket seeing reductions indicate a targeted adjustment based on observed experience.
It's a clear signal that the group life market remains dynamic and competitive, Aria. For employers, it's a demonstration that carriers are actively working to provide value. For us, it's an opportunity to ensure our products remain attractive and competitive, reinforcing our position as a leader in comprehensive employee benefits.
And for me, it's a reminder that every rate change, positive or negative, requires a deep dive into the underlying actuarial assumptions and their potential P&L implications. Let's pivot to a major cost driver in group health, Dorian, GLP-1 medications. Medicare's new pilot program is making waves.
Aria, this is a huge signal flare for the entire group health market. Medicare has announced a GLP-1 bridge pilot program, indicating an accelerating coverage expansion for these medications. What's critical here is the pilot's emphasis on the critical role of behavioral and lifestyle support alongside GLP-1 use to ensure sustained results. Jeffrey Vogel, CEO of Concord Health, put it perfectly. The Medicare news is a signal flare. GLP-1 access is expanding fast, and a lot of those newly covered people are somebody's employee. We know GLP-1s work. An analysis of 37 studies found an average weight loss of 33 pounds. This isn't just about medication, it's about integrated health management.
Accelerating coverage expansion translates directly to accelerating cost expansion for our employer-sponsored group health plans, Dorian. The P&L impact of GLP-1s is already a significant concern, driving up pharmacy spend. The fact that Medicare is piloting coverage and emphasizing behavioral support validates our actuarial concerns about long-term efficacy and cost management. Studies indicating over 60% of lost weight is regained within a year of stopping the medication highlight the crucial challenge. If we're just covering the drug without robust, sustained behavioral health and lifestyle programs, we're essentially funding a temporary solution with significant P&L implications from high recurrence rates and lack of sustained outcomes. Our current benefit designs need an immediate review.
This is exactly where we differentiate ourselves, Aria. Employers are grappling with these costs. A carrier that can offer a truly integrated solution, combining GLP-1 coverage with evidence-based behavioral coaching, nutritional support, and long-term lifestyle programs, becomes an indispensable partner. This is a chance to move beyond transactional drug coverage to holistic health management. We can demonstrate a clear ROI through improved employee well-being, reduced comorbidity, and potentially lower long-term healthcare costs.
Superior employee experience must be balanced against the P&L of delivering it. The cost of comprehensive behavioral programs is not insignificant, and we need to accurately price that into our premiums. How do we ensure engagement and adherence to the behavioral component? What are the metrics for success beyond initial weight loss? Are our provider networks equipped to handle a surge in demand for integrated GLP-1 and behavioral health services? The actuarial models for GLP-1s are still evolving, and adding a variable behavioral component further complicates accurate projection of utilization and cost trends. We need granular data on the efficacy and adherence rates of these integrated programs to refine our reserving and pricing strategies.
Regulatory compliance around coverage criteria and medical necessity will also be under increased scrutiny. Solvency implications are directly tied to our ability to manage this accelerating cost curve effectively through smart benefit design and robust clinical management. It's an investment in health, Aria. And it's an opportunity to partner with employers to manage this new reality, not just react to it. The carriers that lead with integrated, outcomes-focused GLP-1 strategies will define the future of group health.
And the actuaries who accurately price and manage the risk of those strategies will ensure those carriers remain solvent. Finally, Dorian, a significant expansion of the New Jersey Family Leave Act, or NJFLA. This sounds like a compliance minefield for employers.
It's a monumental expansion, Aria, and a critical development for employers in New Jersey, particularly smaller businesses. Effective July 17, 2026, the NJFLA will apply to employers with 15 or more employees, down from the previous threshold of 30. That's a huge increase in scope. Employee eligibility requirements are also being significantly reduced. Only 3 months of employment and 250 hours worked in the preceding 12 months, down from 12 months and 1,000 hours. These changes are estimated to extend NJFLA protections to over 400,000 additional New Jersey workers. Furthermore, the expanded law strengthens job protection for employees receiving temporary disability insurance, TDI, or family leave insurance, FLI benefits.
Monumental expansion is an understatement. This is a regulatory earthquake for our group disability and absence management product lines, Dorian. Expanding to 15-plus employees drags a vast number of small and mid-sized businesses into a complex compliance framework they are likely unprepared for. This directly impacts our STD and LTD blocks. Reduced employee eligibility requirements, 3 months, 250 hours, will inevitably lead to an increased frequency of claims and a broader pool of eligible claimants. Our actuarial models for claim frequency and duration for New Jersey groups will need immediate recalibration. What's the P&L impact of this surge in eligibility? It's not just more claims, but potentially claims from employees with less tenure, which can introduce new patterns into claim experience. The strengthened job protection aspect also increases litigation risk for employers, which can indirectly affect our stop-loss clients if they face substantial legal costs.
Aria, this is precisely where we can provide immense value. Smaller employers who previously weren't covered will be desperate for guidance and solutions. This is a massive opportunity for carriers offering integrated leave management solutions. We can step in to help employers navigate this increasingly complex landscape, offering private plan options where allowed, or comprehensive administrative support for state-mandated programs. It's a chance to gain significant market share by being the go-to expert for absence management and compliance in New Jersey. The demand for robust, compliant solutions will be unprecedented.
Market share is only valuable if it's profitable, Dorian.
The complexity is the opportunity, Aria. Employers need solutions.
We can be that solution, solidifying our position as a strategic partner in benefits and compliance. This is a moment to demonstrate our expertise and capture new business. And for me, it's a moment to ensure that new business doesn't translate into unprofitable business due to unmanaged risk and unforeseen compliance costs. And that wraps up another dense, data-driven edition of Group Insurance Daily Pulse. From Ontario Auto to New Jersey Leave, the landscape is shifting rapidly. Indeed, Aria, opportunities abound for those ready to adopt and innovate, and risks abound for those who fail to account for the numbers. Until next time, stay vigilant and stay forward-looking.